Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. This is Nikki Fu, Commercial Director at My Steel Global, responsible for growth strategy across our new business sectors. Today's discussion focuses on one of the biggest questions in China's energy and chemicals markets. After the July 30th Political Bureau meeting, where is policy support actually headed for the second half of 2026, and which parts of the value chain are being left to fend for themselves? The backdrop here is a broader shift in China's industrial policy. Counter-cyclical tools are back on the table to support near-term demand, while alongside that, a more detailed green and low-carbon framework for the 15th five-year plan is starting to reshape project approval, energy use, and supply chain compliance for years to come. Joining us today is Liao Na, Chief Consultant of Energy Policies and founder of GL Consulting. Liao Na, welcome back.
Thanks, Nikki. The key theme for H2 is that support is real but selective. Stimulus and compliance pressure are pulling different parts of the chain in different directions.
Start with the macroeconomic signal. What does counter-cyclical adjustment mean for markets?
The central bank will coordinate the reserve requirement ratio and rate cuts, which supports the financial pricing of crude and other bulk commodities. But don't read this as a repeat of last September's package. It's moderately strong and targeted, not broad-based. Drip irrigation, not flood irrigation.
If it's not broad-based, where does support concentrate?
Two directions: consumption and China's domestic demand, plus infrastructure and AI-related industry. Property stays stability and floor with no renewed stimulus signal. So soda ash, glass, and conventional PVC don't have a turning point yet. They're trading on existing fundamentals. The clearer channel is two new upgrades policies: equipment renewal and consumer trade-ins. Household appliances and autos become the new demand engine, which is comparatively firmer for ABS, polyurethane and synthetic rubber, and likely arrives earlier than any construction materials recovery. Second is infrastructure, the six networks: water, power, computing, communications, urban underground pipelines, logistics, plus AI plus. This was already a long-term theme, but the timetable has been pulled forward, so real procurement demand should show up in H2.
What does that mean for materials?
Directly positive for HDPE pipe, cross-linked polyethylene cable insulation, and specialized data center cooling fluids. Natural gas benefits too. The computing network needs power peak shaving, and gas-fired generation stabilizes the grid alongside storage and demand-side investment. Hydrogen, green ammonia, and green methanol are also gaining traction as storage carriers for renewable power. Watch the data points tied to 2026 and 2030. They'll show how fast this turns into real demand.
And transportation fuels?
Next half of this year must be defensive posture. Without large stimulus and with EVs still climbing, any gasoline or gas oil recovery is mild, not a rebound. Refiners need disciplined throughput. Pushing runs higher without matching export or domestic demand just builds inventory and pressures margins. Structurally, oil is shifting from transport fuel toward petrochemical feedstock, which raises the value of refinery petrochemical integration.
The meeting also flagged overdue payments and involution-style competition.
That's arguably the most practical signal here. Arrears governance moves from ad hoc handling to normalized, long-term policy with a firm push against involution-style competition. It signals no blanket clear out of traditional capacity. Old and new drivers hand off smoothly. For energy engineering and equipment trading, that's a real chance for payment cycles and cash flow to improve.
Let's turn to the low-carbon side. How does the 15th five-year plan's green framework change compliance?
This is more binding and more quantified. Industry is roughly 70% of China's emissions, so it's the main battleground. The plan sets hard targets for zero carbon factories and zero carbon industrial parks. New energy-intensive capacity needs equal or reduced replacement, and energy-intensive firms must deploy online carbon monitoring. Energy conservation review is now tied directly to carbon evaluation. If you can't account for your carbon, the project doesn't get approved. There's also an international angle, a 5-dimensional carbon management system from local to project level, and clear carbon footprint accounting rules and databases designed to respond directly to the EU's CBAM. From 2027, CBAM exposed exporters must disclose product carbon footprints. Early movers on zero carbon factories effectively secure market access for the next era.
Who gets squeezed and who benefits?
Squeezed are long process steel, high intensity electrolytic aluminium, coal fired building materials kilns. It is on a facing phase out, not just restriction. Smaller suppliers without retrofits will see compliance costs jump once major customers apply strict carbon audits, and high carbon exporters without footprint accounting hit the CBAM wall directly. Next up, benefiting are the efficiency and carbon performance leaders get preference in financing, approvals, and procurement. So do frontier players, battery recycling leaders, green hydrogen scaling into hydrogen ammonia methanol applications, and carbon management software and database providers. Competition is shifting from a pure cost contest to a carbon asset contest.
And traditional fuels longer term?
Each narrow into a more specialized role. First, coal keeps losing share to green power and hydrogen in industrial use. Next, oil keeps retreating from transport toward feedstock. Then, gas is squeezed between electrification and green power on one side and a balancing role on the other. Lastly, refining and downstream chemicals overall are pushed toward greener inputs and verifiable carbon performance, or risk losing supply chain access.
Bottom line for H2 2026?
No broad cyclical recovery yet, but real structural opportunity. Equipment renewal, grids, pipelines, and computing infrastructure get direct support. Transport fuels and property linked chemicals don't have a visible catalyst. And low carbon compliance increasingly decides who gets financing and customer access, not just who's cheapest. It's healthy cash flow and correct positioning in new materials and the six networks that will win the second half.
Thank you, Liao Na, for joining us and sharing these insights. And for those who would like to follow these developments in a more structured and forward-looking way, GL Consulting acts as your China decoder, helping turn complex policy and market signals into clearer, decision-ready insight for global energy and chemicals professionals. Reach out to us for a sample issue of the latest China Policy Perspective report for regular analysis of China's policy direction, energy security priorities, and the broader market implications of geopolitical disruption in the context of China's 15th five-year plan. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to Mysteel Commodity Flux, and thank you again, Liao Na, for joining us today. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.